Welcome to the Travelex Weekly Outlook. This is the one for October 4th. The dollar starts the week in pretty good shape. The dollar did rebound off of its recent multi-month lows. That's as an event-filled week in terms of risk events has caused investors to really pare back on some of their short dollar positions that they have accumulated over recent weeks. In fact, the dollar last week and really over the course of September fell broadly on the view that U.S. interest rates might stay low for an even longer period of time, given the slow rate of recovery that's underway with the U.S. economy. In fact, although we have seen signs that the U.S. economy is improving, many investors feel that it's not improving at a strong enough pace to really chip away at the nation's high unemployment rates. Looking at some of the data that came out last week, some of the encouraging signs that we saw came out of the U.S. GDP report for the month of, or for the second quarter. That was revised slightly upward, and so that suggested that perhaps the U.S. economy entered the third quarter on slightly more stable ground. That could bode better for growth during the third quarter. We also saw that on the negative side, we saw that U.S. consumer confidence fell to a 7-month low for the month of September. So that just goes to show how the U.S. economy really does have more work to do in terms of rebounding in order to bolster views that the U.S. economy is on a sustainable course. The week ahead, for the week of October 4th, it's really going to be an eventful week. As I had mentioned, the key focus is going to be on Friday's employment report for the month of September. On the one hand, the U.S. economy is not expected to lose any jobs on an overall basis. In fact, the U.S. economy is not expected to add any either. But if you look at the private sector employment, that is seen as increasing over the month before. But still, the nation's jobless rate, that is likely to tick higher toward about 9.7%. Again, that would be moving in the wrong direction, and that could influence Fed officials to provide more growth-boosting measures in the coming months. Of course, those growth-boosting measures, they tend to put downward pressure on U.S. interest rates, and that's been at the crux of the dollar's recent decline that we've seen over the past few weeks. Other events for the first week of October, investors will really look at central bank meetings. There's going to be a 2-day meeting in Japan, although no change in policy is expected. Of the 4 central bank meetings this week, investors see the largest risk from Australia, that perhaps they may boost interest rates. Most investors expect the RBA to hike interest rates by 1/4 point. That would bring their yield advantage to 4.75%, or their key interest rate at 4.75% compared to U.S. yields near zero. In fact, that has been a key source of strength for the Australian currency against its U.S. rival. In fact, right now, the Aussie dollar is still near a 2-year high against the U.S. currency, largely built on its yield advantage over U.S. dollar-denominated assets. The other central banks meeting this week include the Bank of England and the ECB, and both of those central banks are not expected to touch interest rates. So the key for the dollar for the first week of October will really be out of the tone of Friday's employment report and what that suggests about more quantitative easing for the Fed. A stronger than expected report, that could cause investors to price out expectations of more help, and that could be a source of strength for the dollar. So that would be the key event to watch for. Outside of that, that'll really do it for this week's edition. Again, for the latest on the dollar, please take a look at Travelex online, and thanks for watching.